Amendment number 96, it's really quite simple. It would ensure that the bill does not reward banks like Wells Fargo, whose management insists on implementing a punishing sales culture that puts consumers at risk. Specifically, my amendment would prohibit relief under Title IV for any bank with more than $50 billion in assets who used in the last 5 years or uses individual sales performance goals or quotas as a compensation metric for branch employees. Last year, when the CFPB and the OCC revealed their consent order with Wells Fargo, we saw just how much damage that type of sales culture can inflict. Wells Fargo created a toxic mix of low employee pay, aggressive sales programs with impossible quotas, and harsh punishments for noncompliance. This forced branch employees, often making no more than $40,000 a year, to open fee-generating accounts without customer consent just to ensure that their jobs were safe. Are these really the type of institutions for which we should loosen oversight? In the 14 months since the initial fake account scandal at Wells Fargo was revealed, the bank has disclosed a steady stream of other scandals, including forcing hundreds of thousands of customers who financed their car purchases with Wells Fargo to pay for collision insurance they did not need, providing advance warning to branches before internal monitors arrive so that branches could cover up evidence of opening unauthorized accounts, targeting undocumented immigrants in efforts to open up fee-generating accounts, and charging customers improper fees to extend interest rate commitments they receive from the bank on mortgage loans, and the list goes on and on. Wells Fargo's sales practices generated universal and bipartisan outrage on this committee last year, and I would urge all of my colleagues to support this amendment, and at the appropriate time, I'd ask for a roll call vote.
Thank you. And although there is significant outrage and concern at what was done at Wells Fargo, I believe that to use this as this is too blunt of an instrument to utilize in terms of dealing with that specific aspect of the inappropriate use of performance goals and quotas. And so for that reason, I must oppose the amendment.
Real briefly, Mr. Chairman. How do you stop somebody from doing what Wells Fargo did? I mean, the CEO came in here. We know that executives made millions off phony accounts. We know that bank tellers and district managers in the branches were facing threats, harassment, even lost their jobs. They didn't meet the quotas in this pressure cooker environment. Those that did meet the quotas and falsified records were called bad apples by CEO John Stumpf when he came in. What's to make people like this that are making tens of millions of dollars off of their own bad behavior and imparting and then accusing their subordinates making, you know, pennies on the dollar for what they're making, accusing them of being bad apples? What's to stop them from doing this? Is not a blunt instrument. This is simply saying, you do this kind of stuff, your bank pays a price. Stop doing it.
Senator Toomey?
Well, I would respond to the question. If my memory serves me correctly, the CEO and other senior members of Wells Fargo's management team were fired. What's to stop the next management team from doing the same thing? Maybe they don't want to get fired. It was right to fire them. But what this amendment suggests, and there's a whole slew of them of the same genre that Senator Warren has filed. I don't know if she intends to offer them or not. But the idea is to weaponize regulation. The idea seems to be to say, if there's a behavior we don't like, and in some cases it's illegal, in other cases it's not illegal, like government-established wage rates, if we don't like the policy, we're going to inflict on them this regulatory burden. So the purpose of regulation generally, and the SIFI designation in particular, is supposed to be about ensuring safety and soundness, not weaponizing it and use it as a club to try to coerce a behavior, in the case of some of Senator Warren's amendments, that we might like. For instance, I understand she likes, and there's a lot of people that like having the government mandate wage rates. You know, I feel just as strongly in opposition to sanctuary cities. But it would never occur to me to suggest that we should impose a SIFI designation on a bank that provides services to sanctuary cities. So I think this whole idea of using this regulatory process as a way to punish, whether it is a violation of the law, which should be punished through other mechanisms, or whether it's a policy we don't agree with, I think that's a very, very bad idea. So I would urge a no vote on any such amendments.
Is there further debate?
Mr. Chairman, if I could just respond. You started by saying that the executives were fired. They weren't fired. That's part of the problem. They were permitted to resign and keep millions and millions and millions of dollars that were the result of their own bad actions. No one's looking to weaponize regulation. What we're looking to do is make regulation effective, because obviously regulation has not just failed, it has failed profoundly. When a company like Wells Fargo can be fully regulated by the Federal Reserve Bank, by the OCC, and they just can't see it, when this bank for years perpetrates a fraud on millions of people across this country, then there's something wrong with the regulatory scheme. And it's time to say, we got to step up those regulations. And what we're trying to do on our side is say, here's some tools that we might use so that the next bank that's sitting out there saying, gee, I wonder how many millions of dollars I can get before someone maybe finally at the end shuts me down and I'll have to retire to one of my 7 homes and spend my millions of dollars, that we want to stop that and get just a little bit of accountability into the system. I don't think that's a bad thing.
Mr. Chairman, I would just say, look, if fraud is being committed, it should be prosecuted, and people should go to jail for fraud. But there's a long list of amendments that have nothing to do with fraud. It has to do with the pay rates of employees. It has to do with whether they're perceived to be outsourcing jobs. These sorts of things have nothing to do with the safety and soundness of the institution. And it is weaponizing the SIFI designation if you say we're going to inflict this on someone when they engage in a policy that we just don't agree with. Look, I think our committee, of all committees, of all senators, we should be concerned about making sure that our oversight of the regulators is doing what it's meant to do, which is to enhance safety and soundness, but not to try to use them to sick them after institutions that are pursuing policies that we disagree with. The Wells Fargo stuff, there's very serious violations there. A SIFI designation, of course, is irrelevant. Wells Fargo is a SIFI no matter what, under this bill or any other. But I just think the idea of weaponizing regulation is not a good one.
Senator Menendez.
Mr. Chairman, first of all, you referred to this as a blunt instrument. I respectfully disagree, but I'd be happy to work with the chair to refine the instrument. And let me just say to my friend from Pennsylvania, who I often work with on issues, I don't consider consumer protections weaponizing. And in reality, you know, in life, sometimes God throws us a Goliath so that we find the David within us. I have experienced that of late. But the reality also is that David, unfortunately, as it relates to consumers, doesn't always win. So I look at this not as a weaponization of regulation. I look at it as an inducement. You want relief? Then don't act in a certain way. It's in essence what we largely do across the board when we want to take, you know, our actions as citizens collectively, and we have governmental actions to make sure that people don't run for a red light. There's a consequence of that. People don't do certain things. There's a consequence of that. And knowing that there's a consequence, hopefully in part creates an inducement for those who might actually violate the law not to do so. So I see it as an inducement. Weaponizing would be that we actually do something against you regardless of your action. That's not the case here. It's simply a very clear standard that says if you act this way, like Wells Fargo did, then don't expect the relief that is going to be given to others who don't act that way. And I see it far different than weaponizing.
Senator Heitkamp.
Thank you, Mr. Chairman. I intend to vote against this amendment, but I also want to make it clear that nothing in this bill would benefit Wells Fargo. But it is critically important that we open up our eyes and look at this problem from the perspective of the American people. The American people are fed up with fat cat executives getting their way with regulation and being, see no evil, hear no evil. They're fed up. They're fed up with no one going to jail, and they're fed up with millions of dollars of executive compensation. So if this isn't the instrument, what is? When do we start speaking to that concern of the American people who every day seem to see someone who is in an income bracket where they can accomplish and do whatever they want to do, and there's no accountability? And they are calling our office. They're asking for changes. I'm going to vote against this amendment, but I have to tell you, if not this, what? When do we start holding people accountable for the actions that they've taken?
Further debate.
Mr. Chairman, only in response to my friend from North Dakota, that it's important we walk out of here when we all like to say that this bill's all about Huntington or First Bank of Sycamore and the smaller, the good-sized, healthy regionals like the 3 banks in Ohio or the smaller community banks, most of whom are doing pretty well these days. That there is some relief for the largest banks in the country, the Wells Fargos of the world, the enhanced prudential standards. It's shall tailor now. The present law is may tailor. This bill is shall tailor enhanced prudential standards, and the bill says periodic stress tests rather than annual stress tests. So with these regulators, again, going back to my not trusting these regulators because I've got my eyes open. I've seen what they did 10 years ago, some of the same people. I've seen the deregulate. I've seen the president fly all over the country talk about deregulation, deregulation, deregulation. You know, we know the White House looks like an executive retreat for Goldman Sachs executives. We know what that's all about. But when we actually are giving some breaks to the largest banks in the country, including Wells Fargo, we're not telling the regulators you've got to do the stress tests every year, and we're saying you shall tailor them. And that is a problem for the large banks. So all I say to my colleagues is don't walk out of here saying, oh, we didn't touch any of the regulations for the largest banks. You did. This bill does. Fix it, and I won't say that anymore.
Senator Heitkamp.
Just one point. I do disagree with the ranking member about what the impact of this bill is on the largest banks. I think it's tailored and it's fashioned in such a way that we are not doing what's been discussed here. I would refer people to the document that I asked be put into the record during my opening statements. We try and respond and provide as clear of an analysis of the language of this bill to prevent the dialogue from being that this is helping the biggest banks in America.
Well, and I would agree, Senator Heitkamp. I mean, to say that giving the regulators flexibility to tailor means that we have changed the regulations that will be applied requires the assumption, which you make, that the regulators are going to be bad regulators, that they are going to do acts that you don't agree with. And I understand, you know, like we said in debating your amendment, I understand your perception of the regulators. Well, I don't share it, but I understand.
No, and I get that. But I putting aside even my skepticism about the regulators, we've changed the language from may to shall. That doesn't give them the flexibility. That says change. And by making it periodic rather than annual, we're suggesting that they perhaps do it less often. So I don't think that's certainly it's exacerbated by my skepticism about these regulators, but it also is a change in the laws that affect the largest banks in the country. And I just don't think any of our constituents think we should be softer on these big banks that brought this economy down a decade ago and caused my and a lot of other neighborhoods in Nevada and all over this country to have such havoc wreaked on them.
Senator Kennedy.
Well, Mr. Chairman, I've listened to this exchange with interest. I don't agree with Senator Brown. And I do agree with Senator Heitkamp. I don't think this bill has a lot to do with our larger institutions. And I'm not against big. I'm against dumb. But I think the genesis of all of this, some of you were here, I wasn't. I was just back in Louisiana minding my own business. But I watched what happened in 2008, and not a single regulator got fired, and not a single senior executive went to jail. And that's why we have problems here today, because acts have consequences for everybody else in America, except those folks. And that was the start of our problem, in my opinion. I don't want to weaponize anything. I think Pat makes a great point. But acts have to have consequences. They do for most Americans. And I think that's the genesis of a lot of the anger in this country.
Thank you. I'd love to jump back in myself, but I'd say it's time to vote. Hearing no objection, clerk will call the roll.